Welcome to Breaking News to Trading Moves. We're looking at a specific development in the European financial sector today, one that's put a spotlight on the German commercial property lender Deutsche Pfandbriefbank, or PBB.
It's definitely the headline of the week. PBB has come out with a warning regarding its financial targets.
And what's the specific issue?
Well, they've stated they're unlikely to hit their key financial targets for 2027. They're now projecting those will likely slip to 2028.
A whole year. That feels like a long way off. And, looking at the more immediate numbers, they also flagged a preliminary pre-tax loss for 2025.
Right, and that stands in contrast to the profit they posted in 2024.
So they went from profitable to projecting a loss pretty quickly.
Very quickly. And the market reaction was swift. The stock fell sharply following the update.
And what's the reason they're giving for all this?
The reason cited by PBB is a subdued commercial property market.
Which is a polite way of saying the market is tough.
It is. It's a signal that the commercial real estate cycle, the CRE cycle, is continuing to pressure lenders. And this is particularly acute within the office sector.
Okay, so when a bank like this, a specialist property bank, warns that its targets are slipping, what does the market do?
The market pauses. It reassesses three specific things: credit risk across all CRE lenders, the conditions for refinancing, and, of course, property valuations more broadly.
Okay, so we have the signal. A German bank is feeling the heat. But our job here is to figure out what that means for the rest of the market. Who looks at this and, sees an opportunity? Let's talk about the winners first.
It sounds a little cold to say, but in finance, distress for one party is often an opportunity for another. So the first category we're looking at involves distressed and opportunistic credit buyers.
The vultures, so to speak?
We prefer opportunistic capital, but yes. The mechanism is this. When banks like PBB pull back or decide they need to get this CRE exposure off their books, they often have to sell loan portfolios.
Because they can't hold them anymore, right?
Yeah.
Capital requirements and so on.
Exactly. And if they have to sell, they're not getting full price.
No, they're selling at a discount.
They are selling at discounts.
Yeah.
If a loan has a face value of $100 million, maybe they sell it for 80, maybe 70 million, just to be done with it. The winners are the entities on the other side of that trade.
The ones with the cash ready to go.
The forced sellers have counterparts, and these are entities that have the scale, the capital, and, this part is crucial, the specific workout teams required to buy these assets cheap.
So what's their game plan?
Their strategy is to buy the debt at a discount, maybe restructure the terms with the borrower, and then monetize that spread over time.
So you need a big balance sheet and a lot of patience. Who fits that description?
You have to look at the alternative asset managers. First up is Blackstone. They're massive in this space. They've raised billions specifically for this kind of dislocation.
And for anyone tracking them, Blackstone is ticker BX.
Then you have KKR. Over the last decade, they've built out a very sophisticated real estate credit arm for precisely these kinds of environments where banks have to step back.
That's KKR, ticker KKR.
And a third name to consider here is Ares Management. They're very active in private credit and have the flexibility to step into these gaps that are left by traditional banks.
And Ares is ticker ARES. So the logic here is pretty straightforward. Banks sell cheap, these guys buy cheap, and wait. But what about the messy middle part? You mentioned workouts. That sounds like a lot of paperwork.
It's a lot of work, period. And that brings us to the second category of winners, real estate services, specifically those tied to restructuring.
The people who clean up the mess.
Think about it. When a loan goes bad or a building is worth less than the debt on it, you can't just ignore it. You need valuations. You need advisory services. You might need to sell the asset in a special situation.
So even if people aren't, buying office towers because they're excited about them, they're hiring these firms because they have to.
Correct. A choppier market actually drives business for these firms. Even if headline transaction volumes, the big flashy sales, are muted, the problem-solving activity really rises.
So who are the main players in that problem-solving business?
Jones Lang LaSalle is a big one. They have a massive capital markets and advisory division that steps in when lenders and landlords need to figure out what a building is actually worth and, what to do with it.
That's Jones Lang LaSalle, ticker JLL.
And you can't talk about this sector without mentioning CBRE Group. They're the largest commercial real estate services and investment firm in the world. They handle everything from property management to loan servicing.
CBRE Group, ticker CBRE. So we've got the debt buyers and the fixers, but let's talk about where the smart money is actually going if it's not going into office buildings anymore.
This is what we call capital rotation. It's the third category of winners. We know that office fundamentals are under pressure, vacancy rates are high, rent growth is flat, or in many places, negative. Investors see that.
So they just take their ball and go home.
No, they just go to a different field. The capital rotates toward needs-based property types or sectors with structural growth. Right now, that primarily means two things: data centers and logistics.
Data centers make a lot of sense. We keep talking about AI and the cloud.
Yeah.
All that data has to live somewhere physically.
Exactly. And logistics is the other side of that coin. E-commerce requires warehouses. These sectors have much stronger demand tailwinds, and importantly for investors, they tend to have longer duration leases with creditworthy tenants.
So you're trading a shaky office tenant for a big tech giant or a major shipping company.
And that supports rent growth and valuations in a way that office-heavy exposures simply can't right now. It's a flight to quality and a flight to growth.
Who are the big landlords in this digital and logistics world?
Well, Equinix is the heavyweight in the data center colocation space. They own the critical infrastructure that, powers the internet.
Equinix trades under ticker EQIX.
Then for logistics, you look at Prologis. They are the giant in industrial real estate. Warehouses, distribution centers. If you order something online, it probably passed through a Prologis facility.
Prologis is ticker PLD.
And one more key player in the data center space is Digital Realty Trust. They cater to a lot of the hyperscalers, the big cloud providers.
That's Digital Realty Trust, ticker DLRR. Okay, so those are the winners, the folks picking up the pieces, the folks fixing the pieces, and the folks who are building completely different puzzles. But PBB's warning was a negative signal. Someone is losing here.
Absolutely. The warning from PDB suggests there's real pain in the market, and we need to look at who's exposed to that. We have to start with the U.S. commercial mortgage REITs and balance sheet lenders.
Okay, explain that connection. PBB is a German bank. Why does a mortgage REIT in New York care?
It's about the read-through. The read-through on credit risk. When a major specialist lender like PBB says, hey, we're having trouble, it causes investors to reassess the risk of holding commercial real estate debt anywhere.
So risk premiums start to widen out.
Risk premiums widen. And that's just a way of saying it gets more expensive to borrow money. It also means the value of the loans you already hold might be questioned.
And if you're a mortgage REIT, your whole business is lending money on properties.
Exactly. So if the market thinks those loans are riskier, your book value comes under pressure. Your cost of funding goes up.
And if you have a lot of office loans on your books,
Then you're right in the crosshairs. It just increases the perceived risk of default and workouts. Investors start doing the math on which loans might go bad.
So which names are the market looking at here?
Blackstone Mortgage Trust is one. Now, it's important to distinguish this from Blackstone, the parent company we mentioned earlier. The parent company buys distressed assets.
Right.
The mortgage REIT, Blackstone Mortgage Trust, holds the loans.
Got it. So the parent company is the vulture. The mortgage REIT is the one holding the paper.
In a simplified way, yes. They're a major lender, so they're sensitive to these credit spread movements.
That is Blackstone Mortgage Trust, ticker BXMT.
Similarly, you have KKR Real Estate Finance Trust. Again, this is the mortgage REIT arm, not the parent KKR. They face the same exposure to funding costs and book value pressure.
KKR Real Estate Finance Trust is ticker KREF.
And Starwood Property Trust is another large balance sheet lender. They're very well managed, but they're still navigating the same environment where the risk premium on COE debt is going up.
Starwood Property Trust, ticker STWD. Okay, so those are the lenders. But what about the people who actually own the buildings, the landlords themselves?
This brings us to the next group of losers, the office-heavy U.S. REITs.
The folks whose names are on the skyscrapers.
Yes. The mechanism here is valuation pressure. If banks and other lenders are becoming more defensive, which the PBB warning suggests they are, refinancing becomes much harder.
And commercial real estate runs on refinancing. You don't usually pay off a skyscraper like a 30-year home mortgage.
No, not at all. You usually have a balloon payment due every 5 or 7 years, and you have to refinance it. If you can't, or if the rate is double what it used to be, you are in real trouble.
And that affects the value of the building.
It pushes cap rates up. And a higher cap rate means a lower property value. Office landlords are particularly sensitive to this because they're already dealing with so much leasing uncertainty.
It's a double whammy then.
It is. You've got operational pressure from vacancies, you have financial pressure from rates.
Who are the big names facing this?
Boston Properties is the definitive name in the Class A office sector. They own some of the best buildings in the country, but they are directly in the path of these valuation pressures.
Boston Properties is ticker BXP.
Then you have Vornado Realty Trust. They are heavily concentrated in New York City office properties.
Vornado is ticker VNO.
And SL Green Realty. They're known as New York's largest office landlord. So when the sentiment on office turns negative, or when financing tightens, they feel it immediately.
SL Green is ticker SLG. All right, we have one final group to cover, the banks.
Specifically, banks with meaningful CRE sensitivity.
Now, earlier you mentioned repricing concentration risk. Let's break that down for everyone.
It just means that even if a bank doesn't have direct exposure to Germany, even if they've never heard of PBB, the market reacts to the asset class as a whole. Investors look for concentration.
So they see a specialist property lender flashing a warning, and they go looking for anyone else who has a lot of eggs in that same basket.
Correct. Investors de-risk. They sell shares of any bank that is perceived to have an outsized CRE concentration. It's a sentiment-driven move. The fear is that the problems at PBB aren't unique to PBB, but are symptomatic of the asset class.
The old cockroach theory. If you see one, there are probably more in the walls.
That is the fear. So you see pressure on regional banks that have been active in commercial lending.
And which banks often come up in this conversation?
New York Community Bancorp has been a focal point for investors regarding CRE exposure for a while now.
New York Community Bancorp is ticker NYCB.
Zions Bank Corporation is another one. It's a regional bank, and investors closely monitor the commercial real estate loan book there.
Zions Bank Corporation is ticker ZION.
And Comerica. Similarly, the perceived concentration risk makes them sensitive to these broader market signals.
Comerica is ticker CMA. So we've covered a lot of ground here. We started with a warning from German lender, PBB, and traced that through to the private equity giants, the service firms, the data center owners, and then the lenders and landlords who are feeling the squeeze.
The key takeaway is that PBB's warning serves as a data point. It confirms that commercial property remains a headwind for lenders. It's not resolved yet.
A story that is still being written.
It is. Moving forward, you'll want to watch for any knock-on effects in the CRE credit spreads. Watch the headlines for major office refinancing, see if they get done and at what rates, and pay close attention to any new guidance cuts from other banks or mortgage REITs.
We will leave it there. As always, a reminder, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for joining us on Breaking News to Trading Moves.